Hello, everyone. Welcome to the February 9th, 2026 IndiView Weekly Market Update. I'm Jeremy Bryan, and this is powered by IndiWealth. Today, we're going to get right into those hot button market issues. So let's just get started. We're going to talk about economic data first, because we're going to get an on-time CPI report. And we're going to get a delayed jobs report from the recent shutdown we had in the federal government. CPI report is inflation. So we're really kind of stuck in the mud a little bit on inflation, is that it's not to target, but it's not dramatically accelerating. And so there doesn't seem to be a sense of broad-based concern outside of, just general affordability concerns. There doesn't seem to be among Fed governors and those kinds of things an immediate reaction to do anything until we start to see a secondary trend, whether that's accelerating inflation that they'll have to work to control, or getting closer to goal when they can continue to cut interest rates. Right now, I think we're in a period of malaise, watch and see, wait and see where it is. Inflation is not controlled. I don't think it's going to be in their target zone anytime soon, but I also don't believe it's dramatically accelerating at this point. So I think this Fed stasis that we've been talking about since our market update and outlook piece in January, I think that continues. That's still our base case scenario, is that we're in a hold period right now until we start to see a change in inflection in one of these things, whether that's inflation or whether that's jobs. With the jobs number, it's a delayed report. It might be a little bit muddy because of the shutdown. Who knows how that works? So I wouldn't put a lot into this one. And again, similar to inflation, we're in kind of this area of low hire, low fire. I still think that's the case because you're getting these mixed data points. The challenger job cuts in January were the highest since 2009. That rang a lot of alarms with regard to, are we going to see massive amounts of layoffs? Checking out earnings calls, we're not seeing a ton of that. Outside of really big companies had some really dramatic layoff numbers, and that's what affected that aggressively. But we're not seeing as consistent across the board. It was a couple of big companies doing a couple of big layoffs. Outside of that, it was pretty sporadic. So you're not seeing a dramatic amount of piling on of one another, of cutting jobs, but you're also not seeing a ton of incremental hiring. Now, you are seeing, again, some of the real-time data suggests that we're coming off of a small bottom here, and that job hiring data is coming back a little bit. Again, it's a very, very short-term blip. We'll see if that sustains. If it holds itself, that's great for job sentiment. It's great for job growth. We'll see where that ends up holding up. But right now, again, I still think our base case scenario is that low hire, low fire environment that would suggest to us that we're not going to see a dramatic amount of economic growth, an accelerating economic environment in 2026, because unless we see productivity really start to ramp up on the artificial intelligence. And everybody's kind of already on that bandwagon. So we have to be a little bit cautious that we're getting over our skis there. Turning to number two, Bitcoin has fallen aggressively. I looked at the numbers this morning, and from its prior peak to current levels is down about 44%. So it's been a pretty nasty decline. With Bitcoin, these nasty declines happen. They've happened in the past several times, and they've happened to a greater magnitude than this several times in the past as well. We've seen a couple of 70% declines in Bitcoin. So you have to understand that when you own Bitcoin, and you have to understand what size you are and how much you're willing to take with these massive drawdowns with these portfolios, and what it's going to do for your overall allocation. Again, that's what you want to concern yourselves with when you're investing in asset classes. Is the reason you diversify is that some things are going to work, some things aren't going to work, but overall you can provide yourself some ballast. But when you include something like Bitcoin, and we have included Bitcoin in our portfolios, when you include that, you have to understand that the level of volatility here is higher than anywhere else. And so you have to at least be comfortable with that level of volatility. You have to understand what the downside magnification is for your portfolios, and you have to make a rational assessment about whether you want to continue to hold it or not. We are not adding to our position at this point right now. Again, we've seen multiple 70% declines in the past. We hold this for part of our, again, diversified. We know it's volatile. We know we have it. So we have a very, very small position in it, but we're not adding to that position right now. We can't suggest with any level of certainty right now that 44% is the end, nor is this telling me that it's a dramatic deal at this point right now. So again, Bitcoin is largely a market where somebody, what's worth what it's worth is what somebody else will pay for it. And right now, there doesn't seem to be a lot of aggressive buying of that cryptocurrency. So we're a little bit more cautious on it. And we're certainly not adding to the very small position we already had. We're not layering onto it at this point right now. Turning to number 3, 59% of the S&P 500 is now reported. And I got to say, the numbers look pretty good so far. So the growth is double digits. If we ended here right now, I think that'll wane down a little bit because some of these consumer companies might come in a little lighter than expected and that kind of stuff. But we're still seeing double-digit earnings growth for Q4 25. We're still seeing companies beating on both revenue and EPS. Over 70% have beat on revenue and over 70% have beat on earnings. I think it's over 75% for earnings. Which that happens constantly, pretty consistently across the board until you start to see real, negative. If something happens out there, then companies miss. But usually this level of beating is pretty regular, just simply because companies manage those numbers and make sure they can beat them. From this perspective, though, that's interesting and has been good is I've been talking a lot, again, since our January market update and outlook piece, about usually in January, we start to see numbers start to come down with regard to the consensus estimates for 2026. I haven't seen that yet. The numbers have usually either been steady or slightly increasing. So we haven't seen companies come out and retrench their earnings as of yet. I think a lot of that is due to, again, a pretty resilient economic environment. I wouldn't call it accelerating, but it's been resilient. Combined with the fact they're not adding a lot of staff, they've been getting incremental productivity from whether it's artificial intelligence or just standard operating procedures that are a little more efficient. It's causing their net profit margins to be higher. So they're more profitable than they were before. And so as long as this growth can continue, the valuation argument, honestly, at any year's basis, the valuation argument's not very good anyway, because it just doesn't tell you a lot about what the next year is going to look like. But when you have earnings growth like this, and then again, projected for 13% plus earnings this year, that's pretty good. That's a pretty good backdrop for the market. The question would be, and can the valuation sustain if that growth is there? Probably. The problem, again, that you run across, especially in the markets right now, is, again, when you're at high valuations, you still come down, you're still not cheap. You're getting back towards average. So, the recent turmoil in the markets that we've seen, it's not like everything is screaming cheap. Now, some of them are getting somewhat close. Some of them have been massively overdone. But in a market sense as a whole, it is not screaming cheap at this point right now. But it is still growing very well. What you're seeing is the market is getting cheaper because earnings estimates are not coming down. Where I start to get worried is if earnings estimates come down during high valuation, you get declining earnings and you get people are willing to pay less for those earnings, then that's when you get a protracted downside. We're not there yet. We're not seeing evidence of that yet. Now, again, this ending, we've seen 59% report. A lot of this back end is consumer related. So that's what I'll be watching a lot for this remaining component is what are the companies that sell directly to consumers saying? What are they doing from an earnings perspective? What are the consumers doing? Is there still a massive shift down towards value-oriented things? Are people being resilient? Are they seeing the K-shaped economy where the high end is supporting, the spending and low end is really retrenching? I want to hear that stuff. It's usually here to the next couple of weeks where we'll know more about that. Turning to number 4, we had a big sports weekend. We had the launch of the Olympics, and we also had the Super Bowl. Super Bowl, in my opinion, was a bit of a dud. The game wasn't that exciting unless you like field goals. It turned a little bit in the late third, but then New England just really wasn't very good. So congratulations to the Seahawks. The other side of this coin, though, is I watched a ton of curling this weekend. I become a pseudo expert every 4 years on curling. I don't. I have no idea what's happening. It's just one of the most soothing games that's out there. If you really want to just kind of pop in, pop out, pay attention when you do, except for the yelling every now and then about, curl and all the other stuff. there's really not a lot of noise. So if you want to doze off on a Sunday, curling and golf kind of seem to be in that same zone for me. About it's a solid one if I just want to take a nap on a couch, but watch something too. So I watched a bit of it this weekend, took a couple of naps on the couch, enjoyed myself. I do like the Olympics. I'm a big fan. It was a bummer. I happened to be awake when Lindsey Vonn, I watched the live version of that, and boy, that was a bummer. I hope she's okay. It sounds like it was a broken leg. That was a tough one, but outside of that, I like watching the Olympics. I think generally it's a fun thing to watch. Having access to it via the streaming apps where you can watch whatever you want, that's great too. So I'm enjoying my Olympic events at this point right now, and we'll see if that continues going forward. So that's it for us this week. Tune in next week where we'll have our next hot button topics. Until then, thank you very much and take care.